Hello, everyone. My name is Lily. I'm the president of the Solana Foundation. And a lot of people here, probably particularly in APAC, probably think about Solana as being the meme coin chain, the Mimi chain. And I would say in the last 4 or 5 years that I've been involved in Solana, I wouldn't say that's entirely true. When I first got involved, we were the DeFi chain, before we were the NFT chain, before we were the gaming chain, before we were the DePIN chain. You might remember that from about a year ago, the PayFi chain, stablecoin chain, payments chain, more recently the meme chain. If you sum all of that together, Solana is the everything chain. And I think that is what global financial infrastructure and what blockchains have always been here to do, to provide this unified global financial infrastructure in the same way that the internet unified 5.5 billion people's eyeballs and attention and time. What crypto is doing is providing this unified infrastructure to unify the wealth, the transactions, the financial pocketbooks of 5.5 billion people. And so the broader kind of concept here is really around internet capital markets. And so I wanted to walk through a couple of concepts here. This is what's next for Solana. And I think this is not just what's for Solana, but this is what is next for all of crypto, where we've been 15 years of kind of speculation during this infrastructure building period. But in my mind, this has always been about making the fullest range of financial assets and ways to use those assets available to the greatest number of people. That's what we call internet capital markets. All right, so the most important problems today, I think, have been solved through a combination of tech and policy. And well, one of the large problems that we're facing today is that today's capital markets don't actually work for everyone. So to quote Larry Fink, who is chairman CEO of the largest asset manager in the world, BlackRock, everyone is anxious about the economy, everyone is anxious about capital markets. I would say particularly even more so after the last 48 to 72 hours. I hear from nearly every client, nearly every leader, nearly every person I talk to, they're more anxious about the economy than any time in recent memory. I understand why. We have lived through moments like this before. Somehow in the long run, we figure things out. Well, okay, let's talk about the anxiety and let's talk about the long run. It might have been true in the past that in the long run everything gets figured out, but if you actually look at what's been happening, let's talk about some trends over the last 50 years. And let's talk about America first, because America is the largest capital market, and when you talk about different types of assets, many of them do originate from the United States. So let's just focus on the US for a second. 27% of Americans believe the American dream, defined as the belief that hard work leads to success, still holds true, which is just in 15 years, it declined by half. All right, so is this still going to figure itself out in the long run? Well, now let's talk about labor and capital as well. It's a common framework for 100 years that there's a trade-off between labor and capital, the two factors of production. Well, 50 years ago, this is another way to characterize the access to the American dream. It took 25 hours of labor to be able to buy one share of the S&P 500. If you fast forward 50 years later, what does it take now? 195 hours of work to buy one share of the S&P 500. What this means is that the accessibility of capital, the returns to capital, and then the returns to labor have been diverging for quite some time. So of course, slowly, but then all of a sudden. And what you see is that chart has gone up and to the right, not in a great way. Then what's been happening to capital markets at the same time is, well, let's hear from...
I've always believed, and I'm not the only one, there's an assortment of other people in our industry, that being public is great for companies. It raises the bar in terms of their performance. It causes them to I think, achieve more than they would otherwise. So I think it's very positive for our ecosystem. I also think it's positive for the U.S. financial markets, for companies to feel comfortable coming public sooner. You will hear the SEC and others worried that mom and pop investors don't have exposure to these names or don't have exposure to these trends or to these companies. And the more that they don't go public into their $1 billion, a lot of those gains will be gone. But people will miss out on this. So I don't think it's healthy. Now,
all All right, so what is Bill Gurley, one of the most successful venture capitalists in Silicon Valley and by extension the world, what is he saying? So it used to be that innovation, tech, was accessible to retail markets because it would go public sooner in life. And what happened in corporate life, and then what happened is now it's frequent that some of the most promising companies will not go public for 10 years. And what that means is all of the upside from that innovation, from that growth, is being absorbed by private markets. And so what you've got a situation where it's 8x the labor input in order to have access to capital markets, and capital markets are staying private for longer, and the access to that is a rarefied group of investors. All right, so another way to characterize this is it's gone up 8x, and you would have to be making $240 an hour if your wages were to kept up with S&P 500. And so what you see is this divergence between capital and labor and the inaccessibility of capital markets to labor. Another way of saying this is that as gains have been privatized through public company or private companies staying private for longer, staying away from public markets for longer. And then what we saw starting in 2008, which also prompted, I would say, probably the invention and the distribution of Bitcoin, is the idea is that losses are socialized. And so what you've seen in terms of losses being socialized is, the national debt in the United States has gone up by 800 times. And who is paying for that? Taxpayers are paying for that. Increase in interest, the cost of debt, up 560x. GDP has also grown, but nowhere close to the extent in order to keep this debt flywheel going and to be sustainable. So what you've got access to capital being concentrated further and further into the hands of the few, and the losses or the gains are being privatized, and the losses are being spread out over the general taxpayer base. And so there's so many different ways that this fundamental problem has been addressed, admired, and it's also really sort of played out in sometimes unpleasant ways in the public square. So you're probably familiar with a lot of the discussions around UBI. That's something that has been talked about really a lot in Silicon Valley. And that's been perpetuated as well, the discussions around AI, which is to say that as labor becomes further and further disadvantaged, particularly with AI becoming more intelligent, more capable than any average human being, then we've got to have a fixed compensation for humans to continue and perpetuating humanity. So that's one universal basic income. That's one way you could go about it. What I think is interesting about crypto is it proposes a different concept, which is community-based capitalism. Instead of universal-based income, which is essentially welfare economy, instead perpetuate something around an ownership economy, which is what crypto has really given us from the beginning, which is instead of UBI, UBO, universal basic opportunity. So as one example of this is there's, in Alaska, there's basically a town, and as a resident, you don't get a fixed income from the community, but rather if the community does well, fishing season goes well, so on and so forth. As a resident, you get a cut of the upsides of that community, and as a result, everyone is more incentivized to actually contribute to that community. This can be effective at a local scale. All right, but back to the capital markets type of topic. So let's talk about the demand side and the supply side for greater participation in global capital markets. Let's talk about the demand side first on the investor side. Again, private markets are increasingly private. If you look down to the right, the tech IPOs in the early days, there was a lot that went public. Obviously, not all of it succeeded, but really the accessibility of tech IPOs has gone down and to the right. And meanwhile, tech has become the greatest driver of wealth, innovation, diplomacy, and all the things that are downstream of that. And its accessibility has only decreased over time. And at the same time, the IPO backlog is very real. And if it's not going through the front door, then what we saw for example, in 2020, 2021, is a lot of this, this demand for public access to capital markets for this to actually just go through SPACs and other means to kind of go through the side door. So the demand is here. And at the same time, demand for public market products, right, for stocks is enormous. And this is one of the reasons why the Mag 7 biggest US tech stocks are something like now over a third of the S&P 500. That might have changed over the last couple of days, but that has been the overarching trend over the last number of years, really last decade. And why is that? Well, because there's a lot of interest, demand for high growth, aspirational, kind of tech-driven innovation, and all of that is being concentrated in the top 7 public stocks, and when there's quite a number of other companies that are staying private for 10 years. But there is one exception, and the one exception is here in crypto. One way to look at it is that it is unfettered access to a public market, and so many of us sometimes wonder, why is it that these assets, for example, a meme coin that has no value, explicitly no value, but has all this price generation, how can that be? One way to think about it is you have all of this pent-up demand for investable upside assets that has nowhere else to go. And if this is the picture in the United States, which is the largest, deepest, most accessible capital market, what does this picture look like in the rest of the world? And I think we know the answer to that. All right, and increasingly, there's supposed to be this convertibility between labor and capital, and we talked about how labor has gotten priced out of capital markets, but it's not just a matter of price either. It's also just a matter of regulation. For those of us that have been in the US tech scene before, there's an incredible amount of work in the background just to be able to even pay employees with stock options or some form of equity upside. And so one part of it is just the market dynamics around it, but there's also quite a bit of regulation that has disadvantaged labor in access to capital markets. Now, enter crypto. What we see on the left side here is some paperwork some of us might be familiar with. HSBC, that's how, if you want to get access to cash in a bank account. And then in the middle, if you want to be buying T-bills, well, you might have to hire someone to fill out the form, manage this, maintain all of those accounts for you. Alternatively, anyone can download a Phantom wallet or pick your wallet and immediately have access to all of the assets that are potentially available through blockchain on the internet. And we go from HSBC, go from kind of these very official-looking websites to really just a Chrome browser that has cute logo of a ghost at the top of it, and a mix of from your L1 assets to your stablecoin assets to money market funds, tokenized products, RWAs that some folks have been talking about as well, and yes, some meme coins as well. Full range of assets accessible to anyone with an internet connection. And bearer assets, these things are not new. They've been demanded. This is actually, I think how most assets have been created and distributed over time. And it's just that over time, as everything became digitized and we didn't actually have self-custody until crypto, what that's meant is over the last 15 to 20 years, slowly but surely, we're now living in a digital world where nobody owns anything. And this is one of the things that crypto brings back for us, the ability to really self-custody, meaning return to the world of bearer assets. And lastly, I just want to point out that alternative assets as well are also no longer sort of only the province of the few. This is probably one of the greatest areas of assets distribution and potential growth in blockchain, access to this asset class of alternatives. And so that's just to articulate a few things on the demand side of why internet capital markets is for us, and I think really for all of blockchain, a big direction. Now let's talk about the supply side for issuers. I think many people here maybe come from a traditional finance background. If you've ever tried to do an IPO or participate in an IPO, the company has to spend between $10 and $20 million, largely on lawyers and bankers, in order to access public capital markets. That's to file an S1, and that is a huge barrier. Right? If you think about what amount of capital I have to raise in order to make that profitable, I mean, you're looking at $50, $100 million fundraise just to make it even worth your time to do this. And there's also quite a bit of new competition with the NYSEs and the NASDAQs of the world. So for example, Texas, trying to build a new financial center. Europe, you've got all of the European capitals have typically their own exchanges. Each of them are fighting for distribution and fighting for a place to kind of be the listing place for these capital markets. But you know what's larger than all of these? And what has larger distribution than all of these? It is cryptocurrency. And so there's existing sets of regulations. This is in the U.S. context for the various ways that these securities can be created, issued to potential buyers. In the near term, what's actually very possible in the near term, CoinList, for example, has been doing this for years, is to wrap around these existing regulations and make existing securities available to a broad audience. This is very doable today on the supply side. And lastly, this is something that is not entirely new to be able to do a direct listing. This has been going on with sort of very well-known tech companies for quite a while now. For example, Coinbase, for example, Spotify, those that have huge distribution. What's not been accessible is for those companies that are not the household names after 10 years. It's very difficult for them to do a direct listing, but with crypto, the audience that the distribution of attention and also access to capital that we have on chain today, this now becomes available to small and medium businesses. So the end state here is here in crypto have been for 15 years highly on the speculative end of the spectrum in terms of ICOs and NFTs and DeFi and meme coins. And I think as our industry grows up, what we're going to be doing is moving to the middle of the risk spectrum and moving into assets that have value, can also command price, and also bring more inclusivity around the world, 5.5 billion people on the internet, into capital markets. And this is where crypto is going, right? Capital markets become a feature. Everyone becomes a trader. Every app is a finance app, and anything can be a financial asset. And that is what we are building starting here in 2025, internet capital markets on Solana. Thanks.